If everyone tried to withdraw their cash today, banks wouldn't survive. Not because of theft, but because the money isn't actually sitting there. That sounds impossible, because we've all been taught the same comforting idea. You deposit money, the bank stores it, and you can take it out anytime. Simple, safe, normal. But what if I told you the banking system doesn't work like a storage locker? It works more like a rental system. Your money doesn't just sit there, it gets used, it gets loaned out, it gets moved around, and as long as most people don't ask for it at the same time, everything looks fine. So today I'm going to show you why banks fear mass withdrawals, how the system really works, and what smart people do so they're never trapped when panic hits. Let's start with the uncomfortable truth. Banks don't keep all your money in the building. They keep a small portion available, and they lend the rest. This is called fractional reserve banking. But don't get scared by the name. Here's the simple version. If you deposit $1,000, the bank might keep a small amount ready and loan the rest to someone else. That loan becomes someone else's spending, which becomes another person's deposit, which becomes another loan. It's like your money gets copied through the system, not as fake money, but as promises. And the system works, as long as trust stays alive. Now, here's where it gets tense. What happens when trust disappears? Because in a normal week, most people don't withdraw everything. They take out a little, buy groceries, pay rent, keep moving. But during fear, people stop acting normal. Rumors spread, social media explodes, and suddenly everyone wants cash right now. And once a crowd starts lining up, the bank's biggest enemy shows up. Speed. Not crime, not hackers, speed. Because the bank cannot physically hand out money it doesn't have on hand, fast enough to satisfy everyone at once. And this is why bank runs are so dangerous. They can happen even if the bank isn't bad. A bank could be following the rules, doing everything legally, and still collapse if too many people withdraw at the same time. It's like a restaurant that works perfectly until every customer in the city shows up in 1 minute. No business can survive that. And here's a scary question. If your bank is stable, why would it ever need to limit withdrawals? Think about that. Now, the next reason banks fear mass withdrawals, it exposes the illusion most people live under. People believe their money is sitting there, waiting. But in reality, your deposit is usually a liability for the bank, meaning it's money they owe you. And they've already turned a big part of it into loans, investments, and long-term assets. So if everyone demands cash today, the bank would have to sell assets fast. And fast selling usually means selling cheap. That causes losses. Those losses create more panic, and now you've got a chain reaction that can destroy a bank in days, sometimes hours. Pattern interrupts. This is the only business model on earth where customers get nervous and the business collapses. Imagine if people panicked at a gym and the gym went bankrupt because everyone wanted their treadmill back. That would be crazy. But with banks, That's basically what happens. The system is stable until people stop believing it is. Now, let's connect this to the modern world, because today, bank runs don't even need long lines outside a building. They can happen with phones. You don't need to drive anywhere. You can move money instantly. One viral tweet, one scary headline, one banking app glitch, and millions of people can hit transfer in the same hour. That speed is what makes modern bank runs even more dangerous than the old ones. And this is why banks love it when people don't ask questions, and hate it when people start paying attention. Now, here's the next cliffhanger. If mass withdrawals are so dangerous, why don't banks just keep all the money available? Simple, because they don't want to. If banks kept all deposits in cash, they couldn't lend, and lending is how they make money. They earn interest on loans, mortgages, and credits. So your deposits are the fuel, and the bank is the engine. But engines aren't designed to give back all their fuel instantly. That's not how the machine is built. Now, you might be thinking, okay, but isn't my money protected? Sometimes, yes. In the US, there's FDIC insurance for many bank accounts, up to certain limits and conditions. But here's the part people ignore. Insurance doesn't mean instant. It doesn't mean zero stress. And it doesn't protect you from frozen access, delays, or chaos in the moment. Because during a panic, the biggest problem isn't always losing money forever. It's not being able to use it when you need it most. Bills don't pause. Rent doesn't pause. Life doesn't pause. So what do smart people do? They don't panic. And they don't try to be heroes either. They stay practical. They keep some emergency cash. Because cash works when systems don't. They spread risk, meaning they don't keep every dollar in one place. They avoid living paycheck to paycheck, because fragile people get hurt first in chaos. And they stop believing the bank is a vault. It's a business. A powerful one, but still a business. Here's the real takeaway. Banks are terrified of mass withdrawals because the system runs on confidence, not piles of cash. And when confidence breaks, the truth becomes visible fast. So don't wait until fear hits to get wise. Understand the rules now, while things are calm, because the best financial decisions are made before emergencies, not during them. If you want more money truth, financial history, and real-world wealth lessons in simple language, subscribe to Cashfree World and hit like so more people wake up before the next panic wave hits. And comment below. Do you think most people understand how banks actually work? Or are they trusting the system blindly?